Good morning, everybody. This is a video that I'm recording on the 15th of December 2021, talking about inflation. And currently, the Bank of England have announced today that inflation in the UK has now risen to 5.1. So let's call it 5% increase in prices of goods and services. Now, I've got an issue with that, because I think actually when you look at the inflation rates that we are all paying at the shop, at the petrol station, with our bills, if we're buying holidays, if we are buying a second-hand car, actually, in fact, that inflation rate is a lot higher than 5%. It doesn't take rocket scientists to work out that, you know, if we just pause for a minute and just think, oh, you know, compared to last year to this year, are you and I spending more money than we would have done on things that we're buying today? And the answer is definitely yes. The next question is about how much. But I can tell you that it's not 5%, which means it's not like if you go to put petrol in your car, you used to pay I don't know, £80, and it's now £81 or something, like £82 or something. So well, what's actually happening is that 80 odd pounds is actually costing you £90, £92. So in real terms, you know, the inflation that we are all feeling is, in my view, probably in the region around 10% rather than the 5%. Now, why do Bank of England and government don't really want us to announce that, you know, that basket is increasing in price? Well, first of all, because if we all say, well, prices of goods and services have risen by 10%, we go to our employers and ask for an increase of at least 10%, if not more, because otherwise we're poorer than we were a year ago. And the reason why we don't want that, because then if wages starts going up, it is a virtuous cycle that keeps going. You know, you get prices go up, wages go up, prices go up, and then we'll become quite a nation where we can't compete with others, because our wage bill becomes a lot higher. So investors don't come, companies don't put in their headquarters and everything else in there. So there is an issue around how you're managing wage growth as well. And that's why containing inflation is key. The average inflation should really be around 2%, is what the Bank of England tries to adhere to. Now, in terms of what I want to talk about also here is, how does inflation get measured? So the Bank of England will have a basket of goods that they look at the prices that those goods cost, say last year or last quarter to this quarter, or last year to this year. So things like petrol, bread, milk, energy prices, these things. So they make up a basket of a typical average consumer. And then they will say, okay, well, this basket last year was costing X, this year's costing Y. What's the difference in prices? Actually, that's why they're saying it's 5%. But my issue with this is, you know, that basket is not adding on things like, for example, if you bought a second-hand car, if you had just booked a holiday, whether it's staycation or going on holiday abroad, if you've moved house, even, you know, you will not be falling within that basket of goods and services that the Bank of England uses to measure inflation. And that does discretionary, what they call discretionary spend, and meaning that not everybody will do that, is not being captured in the inflation rates. And that's why I think if you and I are measuring inflation for ourselves, actually is a lot higher than the 5% that's being quoted. So what? So why should we care about this? Why should you and I, people who invest in properties, people who invest in other asset classes, be caring about this? Well, first of all, in order to control inflation, the really one big measure that the Bank of England has got is interest rates. Interest rates, as we all know, are rock bottom rate at the moment for the Bank of England. It's never happened before. It probably will never happen again once we get over this pandemic. So the challenge is you can't go lower than where we are now, because otherwise you'll be at 0% of interest rate. So what can they do? So they can start putting interest rate up, or at least start to signal that interest rate will go up at a set period in the future. That hopefully then should get people like you and I to start thinking, hang on a minute, I'm not going to go and take on more debt. because they've already told me that the interest rate is going to go up. Whether it goes up or not doesn't matter, but they use signaling as quite an effective tool. Or the second thing is they actually put it up and put the interest rates up. And on Thursday, there's going to be another vote for the MPC Monetary Policy Committee at the Bank of England, that there's 10 people that vote to see whether they all agree as economists to put the interest rate up or not. I don't believe that they will do that, because the rationale is this inflation that they're going to say is happening at 5%, that I'm saying is around 10%. We both then agree that it's not really it's more exogenous inflation. So things are happening outside of our economy. So energy prices from Russia, from all the other countries that we buy energy from, is not a UK only issue. Global supply chain, because of pandemic over 18 months, all factories and stuff weren't being made. Like I remember a couple of years ago, right at the peak of pandemic, plaster for houses was completely unavailable, because Gypsum Plaster UK had shut their factory down for over 3-4 months. So you had supply chain issues globally that have not been making the materials, the chips for the brand new cars, and that then translate into not having any brand new cars to buy. Then people have started to buy nearly new cars, second-hand cars, and that's pushed prices up. So that's why the argument is that the inflation is not a real inflation, in the sense that it's not happening naturally. There's been some reasons why global supply chain prices have inflated. COVID has shut factories, and that's why there's less goods available, more people wanting it, and the prices have risen. So I think they're going to hold the interest rate at current rates at the moment, or the Bank of England base rate. So another so what will be, well, if they're not going to increase the interest rate, what happens next? So what's really going to happen is, or what has been happening is, you have a combination of massive amount of money being pumped in through quantitative easing since 2007. So this was the financial crisis. We went from one crisis to this crisis because of all this trillions of pounds and dollars in the global economy has been pumped in. That cheap money has basically fed in from the banks into us via cheap loans, and these cheap loans have then found itself into asset classes, because the idea is, as an investor, you want to put money, borrow money, put it in somewhere else, and then hopefully the increase in value, you pay your bank, and then you keep the margins. That has also been happening in massive amount, and that's created what I think is an asset bubble in the UK property market. Why do I say that? Well, if you look at the house prices in the last 12 months, on average, everybody will tell you that house prices have risen by at least 10%, if not more, depending on areas that you're looking at. And these has been compounded by a few factors. One, the number of houses being listed by sellers on the market has drastically reduced because of COVID. People didn't want to move. Compound that by the number of people maybe in smaller units, flats, and smaller urban kind of living accommodation that then sold off and wanted to buy bigger rural housing, because they wanted more gardens, etc., especially after the lockdown. So you had less people selling, more people wanted to buy with cheap money. That then contributed to this asset bubble, or this actual increase in prices. So you have that increase in price over the last 12 months. Then also you have an issue with investors, because investors have got cheap money that they need to invest. Where do you put money in at the moment that you can actually then make more money, but at least it's quite relatively safe? I'd suggest that the UK property market has been one of those, and that's why there's been an asset bubble. So cheap money has really flooded into this property sector and snapped up pretty much everything.